We are continuing our discussion of Chapter 13. So this is Class 35A if you are a Monday, Wednesday, Friday person, and this is Class 24C if you're a Tuesday, Thursday. So we're going to continue on talking about stockholders' equity. And now that we've put stocks on the books, right, we understand how to get stocks on the books. Let's go ahead and talk a little bit about some other stuff that happens with stocks. Right? Certainly we know about dividends. We've talked about dividend revenue, and we've talked a little bit about paying dividends. Not a lot, but we have talked about dividends in the past. We haven't talked about stock splits. So this should be a new category, but dividends you should be pretty familiar with. A profitable corporation may make distributions to stockholders in the form of dividends. Dividends can be paid in the form of cash, stock, or other property. Cash dividends cause a decrease in both assets, cash, and equity, retained earnings. Most states prohibit using paid-in capital for dividends. Accountants therefore use the term legal capital to refer to the portion of stockholders' equity that cannot be used for dividends. So we set aside some money we can't pay dividends out of. So 3 dates that are pertinent for dividends. So there's 3 things that kind of happen. You declare it, there's a date of record, and then you actually pay the dividends. So let's talk about those 3 dates. Okay, a corporation declares a dividend before paying it. So 3 dividend dates are relevant. Declaration date. On the declaration date, let's say May 1, the board of directors announces the intention to pay the dividend. So the declaration of a cash dividend creates an obligation or a liability for the corporation. The date of record or record date. Stockholders holding the stock at the end of business on the date of record, a week or 2 after declaration, let's say May 15th, will receive the dividend check. Date of record is the date the corporation records the stockholders that receive dividend checks. Payment date. Payment of the dividend usually follows the record date by a week or 2, let's say May 30. So 3 things happen. The board gets together and meets, and then they say, hey, we've had a good year, we've made some profits, let's pay some dividends. Let's pay $1 per share, right? So the board declared it, pay dividends. Well, stocks get sold back and forth between people all the time. So they have to say, well, who's going to get these dividends? So they have this record date. So date of record is, they say, we're going to pay these dividends to whoever owns it at the end of business on this certain date. So they have this date of record. And then finally they actually go ahead and pay it, right? They say, who's going to get it? Let's round it all up. Let's figure this out. And then they actually, mail the checks or make the electronic transfer or however they do it. They pay the dividends. So 3 dates. So let's look at the transactions that relate to these dates. First, declaring and then paying dividends. Suppose on May 1, Smart Touch Learning declares a 5 cent per share cash dividend on 22,700 outstanding shares of common stock. 23,000 shares issued less 300 shares of treasury stock. On the date of declaration, Smart Touch Learning records a debit to cash dividends and a credit to dividends payable - common, a current liability. So here's that transaction. We're not paying anything. We're just recording that we have dividends and a dividend payable, which is a liability, current liability, right? Because it's within a year. So dividends payable, current liability, and dividends. All right. So then what happens? The date of record comes along. They say the date of record is May 15th. So whoever owns the stock on May 15th, they get these nickel a share dividends. Now, on May 15th, the date of record, no journal entry is recorded. This is simply the cutoff point to determine who owns the stock and will, therefore, receive the cash payment. So nothing happens as far as accounting-wise goes on date of record. Could be somebody in some other part of the company has to figure out who owns the stock and where do we mail the checks to, but no transaction actually occurs. There's not any cash coming or going. There's no liability created. So it's not really a thing that goes in the journal. All right, then to pay the dividend, right? To pay the dividend on the payment date, May 30, Smart Touch Learning debits dividends payable, common, and credits cash. So you actually pay that out, right? And of course you pay cash dividends with cash. So you, of course, debit dividends payable because you're getting rid of that liability. And you credit cash because you're decreasing the asset cash. Then you move those dividends out of retained earnings, right? Remember, our retained earnings is net income minus dividends, right? So you'd have to take that amount of the dividends out of retained earnings. So you debit retained earnings and credit cash dividends. You close the dividends account. That's actually like a closing entry. All right. So at the end of the accounting period, Smart Touch Learning will close the cash dividends account to retained earnings. So that's on the last, right? You do that on the date you actually pay it. You do that at the end. That's a closing entry. All right. So let's talk about preferred stocks. The cash dividend rate on preferred stock is often expressed as a percentage of the par value, such as 6%. You remember last video we talked about preferred stock, and those did have a 6% based on their $50 par value. Sometimes, however, cash dividends on preferred stock are expressed as a flat dollar amount per share, such as $3 per share. Remember that a dividend preference on preferred stock does not guarantee that a corporation will pay dividends equal to the preferred amount. A corporation may fail to pay the preferred dividend if, for example, it does not have the cash to fund the dividend. This is called passing the dividend. And the dividend is said to be a dividend in arrears. A dividend in arrears occurs when the preferred dividend has not been paid for the year and the preferred stock is cumulative. Cumulative preferred stock is stock whose owners must receive all dividends in arrears plus the current year dividend before the corporation pays dividends to the common stockholders. Non-cumulative preferred stock is preferred stock whose owners do not receive past dividends. So let's take a look at how these things work. Suppose Greg's Games preferred stock is cumulative and they didn't pay the dividends. All right, let's look at that. So to illustrate, assume a fictitious company, Greg's Games Inc. has 1,000 outstanding shares of 6% $50 par value preferred stock. The journal entries to account for the declaration and payment of a cash dividend on preferred stock are similar to those for common stock. The only difference is that dividends payable - preferred is used instead of dividends payable - common. For example, if Greg's Games has 1,000 shares of $50 par, 6% preferred stock outstanding, and 2 million shares of $1 par common stock outstanding, preferred stockholders will receive 3,000 of any cash dividend declared, so total dividends must exceed 3,000 for the common stockholders to receive a dividend. Right? Preferred get theirs first. If the year's dividend is equal to or less than the annual preferred amount, the preferred stockholders will receive the entire dividend, and the common stockholders will not receive a dividend that year. But if Greg's Games dividend is large enough to cover preferred, the preferred get their regular dividend, and the common stockholders receive any remaining amount. So they could actually get more than the preferred. Just depends how much the dividend declared is. Just the preferred people always get theirs first. So let's take a look at what this would look like, right? Declaring and paying stock dividends preferred. Suppose Greg's Games preferred stock is cumulative, and in 2016 they did not pay any dividends. Before paying common stock, Greg's Game must first pay preferred dividends of 3 for 2016 and 3 for 2017, a total of 6. All right, assume that on September 6, 2017, Greg's Game declares a $50,000 total dividend, right? So here's that declaration, cash dividends 50, dividends payable common, they get everything over the preferred gets their 6,000. A stock dividend is a distribution of the corporation's own stock to its stockholders. So you don't necessarily always have cash dividends. Sometimes you get stock. So, unlike cash dividends, stock dividends do not give any of the corporation's assets like cash to the stockholder. Stock dividends have the following characteristics. They only affect stockholders' equity accounts. They have no effect on total stockholders' equity. All right, so you think about it. They're issuing stocks that have been issued, so they're not really affecting the equity. You can't, you're not going to be affecting the equity up or down. It's like you're just giving them stock that's already out there. So it really doesn't, it's kind of a wash. They have no effect on assets or liability. The corporation distributes stock dividends to stockholders in proportion to the number of shares they already own. Why would they do this? Well, a company issues stock dividends for several reasons. To continue dividends but conserve cash. A company may wish to continue the distribution of dividends to keep the stockholders happy, but may need to keep its cash for operations. Issuing a stock dividend is a way to do so without using corporate cash. It reduces the market price per share of its stock. Depending on its size, a stock dividend may cause the company's market price per share to fall because of the increased supply of the stock. One objective of issuing a stock dividend might be to make the stock less expensive and therefore more available and attractive to investors. To reward investors, investors often feel like they have received something of value when they get a stock dividend. A lot of people actually like a stock dividend. They would like to build their portfolio and they really like getting these stock dividends, so they forgo the cash anyway. They like that. All right, so it is possible to get a dividend that's not cash. Typically the other alternative is stocks. All right, stock splits. So this is a new concept. I don't think we've really talked about stock splits yet. A stock split is fundamentally different from a stock dividend. So it's not a dividend. It's not the same thing. A stock split increases the number of issued and outstanding shares of stock. A stock split also decreases the par value per share, whereas stock dividends do not affect par value per share. A stock split also decreases the market price per share of the stock. A 2-for-1 stock split of a $2 par stock with $20 market value will result in 2 shares of $1 par value with approximately $10 market share per share. So the company, what happens is the company is out there, they're watching their stock price. They may have a lot of reasons to do this, but you can just imagine that a company says, well, we'd like our market price on the stocks to be lower. So if we have 1 million shares out there, let's split them. So from now on, from this certain date, everybody who has a share of our stock now holds 2. And we just split those. It's like for every 1 you get, now you get 2. So it's like you imagine you've just doubled your number of shares. Well, of course, doubling the number of shares, that you don't get any additional equity, so they're not really worth any more money, so you split that. So if stock is $50 per share and there's a 2-for-1 split, now it's worth $25 per share. And of course it can go up and down with the market from there, but now everybody who had that 1 share now has 2. If you had 50 shares, now you have 100. Some stocks split a lot, some stocks don't split at all. So just interesting what different companies do. There is a table on page 666, 13-9, that summarizes the effect on the accounting equation. So what happens with dividends and stock splits, right? So when you have a cash dividend, you're going to decrease your assets, right? When you have a cash dividend, you decrease your assets, right? Because you're paying out some cash. You have no effect on liabilities, no effect on stock, no effect on common capital. Retained earnings go down because dividends come out of retained earnings. And so on with different choices. Stock splits have no effect on anything because it's just everything divides exactly in 2. All right. So that's it for now. When we come back, we'll talk a little bit about the balance sheet and how we report stuff out, but we're just about done with this chapter. All right, good luck to you. I'll see you on the next video.